one of the interesting little nuggets of information that I came across while I was doing my research and finished up my slides on Sunday night was the number of pages in the Internal Revenue Code. So ironically enough, the number of pages in the Internal Revenue Code when it was originally founded in 1913 was 27 pages. In 1986, it grew to 26,000 pages, and in 2016, it has grown to 70,000 pages. In the last 5 years, I could not find the number of pages, but I know that thousands of pages, specifically in relation to the governing law listed below, have been published and enacted into tax law since. So if your tax preparers are a little flustered in the coming tax year, or have been over the last few tax years, that might shed a little light as to why. So that being the case, the fun-filled tax individual and business tax update section is also supplemented over the next 30 minutes with considerations related to sunsetting tax provisions, which I believe is actually where a lot of the time, a lot of the applicable conversation will occur. But what I will say is that every individual is different and every business is different. I attempted to pull out items that I believe to be most applicable to our client base and to clients of similar shapes and sizes. But at any time during the conversation, if you have any questions, comments, and/or concerns, please don't hesitate to drop a note in the comments section, and we'll do our best to get to you or to get you a response. If not during the presentation, we'll get you a response afterward. Our contact information is provided, and I believe the slide deck is also provided for everybody's reference. So that being the case, we'll kick off the individual tax highlights, which my partner Bill eloquently referred to as the land of singles from a tax planning perspective, which I think is a good way to put it, right? Nobody ever planned themselves out of taxes using these particular items, at least in a very meaningful way, but individually, these items, albeit small, can provide a tax benefit to the taxpayer at any given time and in any given year. The items that we chose to highlight in this portion of the presentation are listed here on this slide, which has most of them, right? And we'll mention each of them briefly, focusing most importantly on some of the ones that I think are going to be more of a consideration for most of you on the line here. So medical and dental expenses, for example, there's a permanent 7.5% AGI threshold, as opposed to a 10% threshold that formerly existed, which is a beneficial reduction and a threshold allowing you to potentially qualify for more deduction on your individual income tax return in 2022 versus 2021. Charitable contributions, on the other hand, is a reversal. So what the IRS encouraged individuals to be charitable in 2021 by allowing non-itemizers on their tax returns to deduct $300 or $600 depending on your filing status, and that was actually in 2020 and 2021. That is currently not extended for 2022, meaning that you're back to being subject to the itemized deduction rules and whether or not you itemize, as far as whether or not you're going to benefit from any charitable contributions. As far as qualified tuition is concerned, we have a transition from a tuition and fees deduction to a lifetime learning credit enhancement. And what that means is that we have a repeal of the tuition and fees deduction for tax years beginning after 2020, but an income limitation increase for the lifetime learning deduction that you can, or lifetime learning credit that you can claim, particularly or specifically if your MAGI is between 80 and 90 for individuals or 160 and 180. If you file a joint return, your lifetime learning credit can be applicable for individuals with qualifying tuition and fee costs. A new and exciting provision is the student loan forgiveness concept, and I call it a concept because it hasn't, while being broadcast publicly, has not been something that has been clarified from a how it will actually play out perspective. Student loan forgiveness is is specifically the ability to receive forgiveness of up to 10 or from between $10,000 and $20,000 of your student loan indebtedness, depending on your income that you make in any given year. Specifically, income earners below 125 for individuals and 250 if you file a joint return. This discharge of indebtedness would not be subject to tax per all of the recent communication. However, it has not been widely or experienced at all yet. In practice, it is a benefit that is promised and should be available to individual taxpayers in the future. A unique concept buried within this particular promise is that married filing jointly returns can be recalculated under married filing separate standards to determine whether one of two spouses or one of each of the spouses can qualify on their own versus qualifying or not qualifying on a married filing joint standard. So what that means is that one spouse makes less than $125,000, but combined and in total married filing joint, you would otherwise have more than $250,000 of AGI, then you would be able to file separately and potentially receive the benefit of the student loan forgiveness as an individually filing spouse. That is a consideration that should be discussed with your tax preparer. And if you do not have one, I recommend seeking advice from a tax preparer, because generally there is a penalty for filing separately as a married couple from just a general tax perspective. But that being the case, in the event that you can thread the needle on that one, you may be able to receive a $10,000 or $20,000 benefit at an individual spouse level by taking advantage of this specific provision. The deductible interest on primary residences, the only item that we should specifically highlight here is that while we were permitted to deduct mortgage interest on $1 million residence or $1 million of indebtedness in 2022, that is reduced to $750,000 in it's $1 million in 2021. In 2022, it's reduced to $750,000. So small caveat that may have a meaningful impact on your itemized deductions for 2022. The child tax credit was not extended, as mentioned here. Before the phase out, the child tax credit offered up to $3,600 per child under age 6 and $3,000 6 through 17. And some of that was even available via advance. In 2022, we revert back to a smaller credit, which is $2,000 per qualifying child under the age of 17, with only $1,500 of that credit being refundable. Obviously, all of this still remains subject to phase outs, and those phase outs are listed in here for your information. Lastly, just a reporting item for the earned income tax credit. We've made this easier to claim. Well, the IRS has made this easier to claim, and in particular, the American Rescue Plan Act, which removed the rule that you needed to provide name, age, social security number to claim the credit. So Jess touched on the next point slightly when she was going through her comments, and you will see this multiple times throughout this presentation because it is an important provision that is going to significantly impact taxpayers. And it's not a widely discussed or a common tax provision that individuals think about all the time, which is the 461L excess business loss limitation. So as Jess mentioned, this is a limitation on the ability to deduct losses in excess of certain amounts on your income tax return from businesses. In simplest form, if you have multiple businesses that are not connected via a singular tax return, you could become limited in your ability to deduct losses in excess of $500,000 or $500,000 indexed for inflation. I think Jess said it was $540 for married filing jointly taxpayers, meaning that you could lose a benefit of a business loss that gets created directly resulting from an investment therein during 2022. You would not have noticed this limitation in 2020 or 2021 because, or in 2020 or 2019 or even 2018, because there was relief provided whereby the Tax Cuts and Jobs Act, which created this created this limitation, was suspended from its enforcement of this particular limitation for a number of years to affect a tax benefit or a tax stimulus endeavor during the COVID era, which was those couple years. So what this means now, and you were probably reintroduced to this in the event that it was applicable to you in 2021, and you certainly will be in 2022, is that you're now going to have to plan around this limitation when you're planning to offset business income and business losses from different sources. So whereas we formerly had specific concerns regarding the categories of income and expenses on your tax returns and your ability to offset one with the other, we now have an additional consideration, which is the 461L excess business loss limitation, which could further restrict your ability to take advantage of tax benefits created by tax deductions or tax losses that flow through certain businesses on your tax returns. So stay tuned on this one. There's more to come a little bit later in the presentation, but this certainly is an important item to bring up with your tax preparer if you're not conscious and aware of it at the moment, or if you have any suspicion that this may apply to you starting in 2021, after 2021, or for the duration, which is now through 2028, as Jess mentioned. I thought it prudent to mention, because we get plenty of questions about this on a regular basis, that we had an individual tax benefit that got created through the CARES Act, which was the allowable carryback of previously ineligible suspended or net operating losses that existed on your tax return. The carryback actually dated all the way back to, and was required to, in some cases, date all the way back to 2013. Depending on when the net operating loss was created. The reason that I bring this up, not to repeat previously communicated information, was that this was a beneficial provision, but execution by the IRS has been suspect, which is my last line here. And that means that a lot of taxpayers were permitted to take advantage of this particular change in the tax law. And this created a substantial benefit for a lot of taxpayers over the course of the last few years. That being the case, what has been proven is that the IRS processing of these particular carryback claims, because of their unfamiliarity with the provision, and because of their restriction on employee base and expertise and let's just say time in general, has been bad. So we have a number of clients that we expect will receive the benefits claimed in the coming months, or hopefully in the coming year, but they have in some cases been delayed or deferred from ability to collect the refunds claimed for more than 2 years now. So stay tuned on this one. One of the things to mention in this, among other things that we call the IRS regarding on a regular basis, is that there is limited information that can be provided with respect to the processing of these claims. The IRS is very vague in their responses regarding where claims are at, what stage of processing they're in, and whether or not there are any issues with respect to the method or the form in which the claim was made. So on a sunnier note, the IRS has highlighted now what's called 1099-K reporting. This is a transparency provision, which basically means that where previously unrecognized financial transactions occurred because of thresholds that were perceived to be higher than they should have been, we now have highlighted standards and narrowed standards that actually will require certain individuals to report and or receive reporting related to transactions that they previously weren't exposed to IRS reporting on. This is the 1099-K reporting specifically. The previous threshold was $20,000 or 200 transactions a year. It is now $600 no matter the amount of transactions. So what that means is that you could potentially receive new forms this year, or potentially be required to submit new forms this year, depending on where and what you're doing with respect to certain things. You know, some examples of the things that require 1099-K reporting are gig work, side hustles, vacation homes, condo rentals, Airbnb, even in some cases roommates. So lastly, from an individual perspective, the one thing that I wanted to bring up is that we have preached throughout our client base, and I will continue to preach it, that the ID.me account exists, and that ID.me account can be a valuable resource to taxpayers and to tax preparers on behalf of taxpayers, because it allows you direct access to certain IRS information related to specific individuals, where their refunds are at, any notices that are outstanding, and a history of tax payments and other items that may directly impact the tax returns. A quick cryptocurrency update is that cryptocurrency, the more prevalent it becomes, the more regulated it becomes. So we now have enhanced definitions of things like brokers, i.e. who is required to report the status of transactions, gains, losses, and whatnot. You can read the definitions that are in here. I think the most important items are that the 1099-V report for 2023 returns will be in existence. So you will see, again, further and or enhanced reporting, things you may not have experienced before. You may have used spreadsheets before to report gains and losses, or you may have kept your own detail on your crypto gains and losses, whereas you should be receiving specific reporting from newly defined securities brokers on a foregoing basis. And lastly, an important planning note is that a recent clarification was that wash sale transactions do not apply with respect to cryptocurrency transactions. What that means is that formerly, or for certain securities transactions, the sale at a loss and the repurchase of a similar asset or a similar security immediately following that sale or within a specified time frame would not qualify for recognition of the resulting loss from the initial sale, right? Whereas for cryptocurrency, because it's treated as a sale of personal property, it's actually treated, you have the ability now, and it's explicitly stated in the tax law, you have the ability now to actually take advantage of a sale and repurchase of a similar asset without being restricted on the ability to take the loss created by the initial sale as a result of the corresponding purchase immediately thereafter. That is something that you should talk directly with your tax advisors on, because if not reported correctly, you won't get the benefit of the loss on your tax return. So moving on, and I'll say more applicable, the bigger tax items related to the business tax highlights are the next few items, right? So qualified business income deductions are the first items that we'll talk about. In particular, the QBID, or the Section 199 Cap A deduction, is a 20% deduction that gets created for pass-through entities. That was created through the Tax Cuts and Jobs Act in response to the reduction of the corporate tax rate to 21%. This was the equitable measure taken to, I'd say, make it fair from a tax rate perspective between individual taxpayers who report their pass-through activity on their individual tax return versus corporate taxpayers that are responsible at the entity level for tax. The only and the most important thing that I will bring up here is that this deduction is something that's frequently missed. This is a deduction that you can take full advantage of pending certain limitations with respect to wages and or business property values. If not planned for correctly, certain individuals, particularly small businesses, may not receive the benefit of the full 20% deduction that this creates. And what you should plan to do is to make sure that you are not limited in your ability to take this deduction, because W-2 wage planning at the owner level is an easy thing to correct in the event that you are not qualifying for 100% of the 20% deduction at any point in time. The interest expense limitation is brought up here because it is changing. For small business taxpayers, this is less important of an issue, and small business taxpayers are now defined as a $27 million or less business, I believe over a 3-year average period. So you have a qualifying small taxpayer exception to this rule, but for any taxpayers that are in excess of that, you could be subject to a 30% business taxable income interest expense limitation. That's a mouthful. But what that means is that your interest expense that could reduce your business taxable income could be limited depending on certain metrics that are stated within this new Section 163J, or newer Section 163J. Why it's important is that calculation is changing from 2021 to 2022 from what used to be an EBITDA calculation, and that EBITDA calculation is earnings before interest, taxes, depreciation, and amortization. to an EBIT calculation, meaning that the threshold under which the interest can be deducted is increasing, meaning that you're going to be able to deduct less of your interest on a foregoing basis than you formerly were because the calculation has changed. Similarly, the excess business loss limitation, again, which we touched on earlier, this is not entirely a voluntary tax, but this is certainly a tax that can be planned around in the event that there's enough complexity in your tax world. What I'll mention here, in addition to what was previously communicated with this particular provision, is that if your entity is structured correctly, i.e. through a roll-up structure, and or if your taxable income at varying locations on your tax return, i.e. where do I report my taxable income and where do I report my taxable losses, are planned for correctly, which is just a timing and an organization exercise, then you can typically plan yourself out of the 461L business loss limitation. So something to be extremely communicative with your tax preparer on a regular basis, because this is not a limitation that you should be subject to if you can create the appropriate scenario whereby you don't need to be considering that or be restricted by that. From a depreciation perspective, our bonus depreciation, which if anybody is our client, has heard a lot about this over the last few months. But from a depreciation perspective, our bonus depreciation is being reduced from 100% in 2022 to 80% in 2023. What that means is things like large scale acquisitions, buildings or large pieces of property and equipment could yield less of a benefit on a foregoing basis than they formerly did. At 80% is still a good benefit, but obviously not as good as 2022 at 100% in the preceding years. But what you should be cognizant of is that in its place, Section 179 can serve as a stopgap in the absence of the 100% bonus depreciation, so long as you qualify under the eligibility requirements, particularly and most restrictively the total equipment purchases limitation that exists within Section 179. 179, another thing that's important, and Jess mentioned it because there are other tax credits and deductions available associated with them, is that 179 extends further than bonus depreciation does on certain items, i.e. HVAC and other items that are listed in here. HVAC, ventilation, air conditioning, fire protection, and alarm systems, where those items may not be bonus eligible under the rules because they don't fall into a category under 15 years in most cases. Meals and entertainment have been the saga that keeps evolving over time, but the highlight is that entertainment expenses became non-deductible and then became partially deductible, and now are governed by a fairly strict set of rules and regulations. And online, in any case, if anybody has any type of comments or concerns or questions regarding their business meals and entertainment, there's plenty of information out there on that. But in particular, your tracking of these types of expenses has become a whole lot more important over the last few years. And the reason for that is that what used to be a blanket consideration of 50% is now restrictive regarding the nature of each individual specific expense that you incurred during the year. So entertainment, for example, can either be 50% or non-deductible, depending on which category it falls into. Meals, for example, on the whole other note, can be 100%, 50%, or 0% deductible, depending on what category they fall into. And I've got a list on each of these last two slides, and I'm running out of time, so I'll move quickly, but I got a list on each of these last two slides of examples which create the benefit of either 100%, 50%, or 0%. I shouldn't call 0% of benefits, but deductible in any given year. Quickly on reporting requirements, we have some new reporting requirements. If you guys are our clients and you have a partnership or S corporation, you certainly heard about the schedules K2, K3 with respect to foreign transactions that were introduced in 2021 and even created a delay in some of the filings that we were able to push out before April 15th of 2021. But that being the case, there's just this morning, there was further clarification on these particular new forms that were created, and these are, transparency provisions. These are items that are intended to further clarify certain activity on individual income tax returns. So they are specifically related to foreign tax credit type determinations. And all I will tell you is that if you are involved in partnerships and if you are exposed to foreign tax credits, then there is the chance and there is the likelihood that you will be exposed to these particular forms. Stay tuned, but there will likely be communication from your partnerships and your S corporations to the individual shareholders and or partners regarding whether or not they are going to provide these forms to you. This is the most recent guidance, and if you receive that communication, you have a certain amount of time to request these forms in the event that they will be required to be reported on your individual income tax return. Lastly, from a reporting perspective, you have basis reporting requirements, which were further enhanced and highlighted, and new forms created in 2021. Particularly Form 7203 for S Corporation shareholders may have been something that you guys were exposed to this year. But under certain circumstances and with respect to certain activity that gets reported on your K1 from an S Corporation, you may have then been required to file Form 7203, which is a determination and an explicit statement of your basis in each of those S Corporation holdings that you have in order to warrant treatment of certain items, i.e. deductions, S Corporation distributions, stock disposals, and or loan repayments on your individual income tax return. So because of the lack of clarity in the past, your tax accountants and you are now required to work in conjunction with one another to properly report your basis in each of these holdings on a forward-going basis and over the past year here, so that the IRS is certain that the treatment of these particular items is appropriate on your individual income tax return. So quickly, through sunsetting tax provisions, I included a chart of the timeline of events that is to come with respect to sunsetting tax provisions from the Tax Foundation. Feel free to peruse this. I will highlight certain items that we feel are important items that should be considered in the coming years. So in 2026, the individual income tax rates will increase. And when I say increase, what it really is that it's generally higher tax brackets become broader and the top end range of the tax scale increases, which means that more of your income can fall into higher income tax rate categories on a forward-going basis. This starts in 2026, so we have plenty of time to worry about it, but something to keep in mind nonetheless. We have estate tax exemptions that are likely positioned to fall. Our estate tax exemptions formerly were, they are currently we're in very favorable standing from an estate tax perspective as it stands today. We have a high limitation, we have a high gift tax exemption, and we have a high threshold for tax upon death, making some of your estate tax planning a little bit easier than it formerly was. What I will say is take advantage of that while it lasts, because after 2026, we have the opportunity, or we have the likelihood that this will revert back to a lower number, making it more difficult to plan yourself out of estate tax on a forward-going basis or from that point forward. So while we have the opportunity, and given the current political environment, which is likely to be a stalemate from a tax legislation perspective for the next couple of years, it's strongly suggested that you have conversations with your tax preparers regarding how your estate should be structured, and if there are estate tax considerations that should be taken advantage of today, as they may not exist tomorrow. As I mentioned earlier, bonus depreciation is being phased out as we speak. That bonus depreciation is approximately a 20% reduction in benefit over the next 4-5 years. Until ultimately in 2026, the bonus depreciation is slated to be 0, or 20% actually, which is a significant reduction in benefit that formerly existed, and it's going to significantly change tax planning for fixed asset acquisitions on a forward-going basis. Lastly, our qualified business income deduction is slated to drop off in 2026, meaning that if you're not appropriately planning to take full advantage of that deduction now, I would talk to your tax preparers to make sure. That is a provision where it's difficult to go backwards and recreate a situation and or an opportunity to take full advantage of it, but on a forward-going basis and for the remaining years that it exists, It is something that should be considered in its totality with respect to the entirety of your business income that's reported on your income tax return in a collaborative discussion with your tax accountant.